Hello, Jens. How are you?
Hello, Theo. I'm fine. Thanks for asking. How are you?
I'm fine too. Fine too. Very, very well. And it's time for the economic indicators, which are the important, right?
That's exactly right. And I really look forward to share my thoughts here with today's audience.
Also,
Yeah, nothing to ask today. Only to say, have a nice weekend. Enjoy
yes,
yourself. And
yes. We will see next week with the interest rates and all this stuff. What's gonna
exactly, it's the ECB, and the week after we have the Fed. So quite
yeah,
packed, to be honest. I think
yeah.
wasn't not really sure if it mattered, but somehow it's a sign. I think the Polish central bank just cut rates into an environment with still quite high inflation, if I'm not
Okay.
mistaken.
They are
Um,
taking a high risk, these guys, huh?
well, I just read through some comments. So it was just a coincidence that I saw this on Twitter, and,
Yeah.
and the guy who posted this then got a response from a obviously Polish trader, and he said, "Well, guys, well, this is just because we have elections soon, and so
Oh,
they will potentially hike
makes
again."
sense.
Yeah, but however, I think we are running into probably some trouble right now with people expecting cuts from the mid 2024s, and then on the
Yeah,
other
yeah.
hand, inflation is picking up again. We have inflation next week,
Yes,
right?
yes, yes.
So and
True, true.
with oil prices pushing
They're
higher,
still spiking.
yeah.
They're moving upwards very aggressively, I can say. So we will see what the future uh, will reveal.
I just realized you already allowed me to share my
Yes,
screen, so this
yes,
is exactly
yes,
what I did
yes.
right now.
Okay,
So
awesome. So enjoy the webinar. Have a nice weekend, and I will talk to you next week.
I look forward to it too. Have a nice
Thank
weekend
you.
too. See you. Bye
Thank you.
bye.
See you.
So, yeah, hello, and I welcome you to today's Trading Spotlight webinar. Topic are the four most important Forex economic indicators, probably in the current environment. We are also talking about economic indicators in general, and we mentioned already too, which we will get an idea of in the upcoming 2 weeks. I think it's I mean, even if the overall agenda isn't packed. But interest rate decision, especially from the Fed on the 20th, probably also from the ECB a little earlier next week on Thursday, and especially the inflation data next week on Wednesday. They are very, very interesting, to be honest. And why they are of interest, this is exactly what we want to dig into today. Before we start, certainly, as always, I want to give an overview of the risk disclaimer here, that you please understand that trading leverage products involves risks which may not be suitable for all investors. And before you start trading, that you please make sure that you're comfortable with the risk you're taking, that you are aware of the risks, and that you download a demo on admiralmarkets.com. Test the trading within the simulated demo environment, and then see if this product suits your risk profile, and then taking it from there. If you have further questions, reach out to Admirals directly, ask your questions. About Admirals in general, is it really necessary to introduce Admirals further? I think the over 20 years in the business speaks for itself. Fully regulated broker, very competitive offering when it comes to FX trading, but also when it comes to trading indices. In addition to that, also very, very great trading mobile apps. I highly recommend downloading them to your smartphone and checking them out. They're really cool, really cool. There's some, for example, if you're aware of that, fractional shares, for example, buying fractional shares, sometimes you might say, hey, I want to invest, let's say, kind of, I don't know, 1,000 euros each month. Okay. And then you want to buy Tesla, and you see, okay, Tesla is trading currently at around 250 USD. So you might say, well, I'm buying for Tesla. The thing is that obviously you can buy a little more than that. and 4.3, for example. And now the thing is, now you have to calculate, you have to say, okay, well, I have 1,000 euros. This is then the currency pair, and then I have to convert it into US dollar, and then I have to divide it by the current share price from Tesla, and then blah, 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 blah. Calculate it yourself. Within this trading app here, you get the amount calculated directly. So you say, I want to invest 1,000, and then it shows you how many shares you can buy. And not just shares, full shares, let's say, but also fractional shares in addition to that. So really cool tool. Just check it out. Go to the App Store, whichever you might use, App Store, Apple, or the Play Store here from Google. But that's it around the trading app. Now let's move on here to the agenda today and have a look here at the GDP. Respectively, interest rates. This is what we want to focus on the most of the time. Then employment numbers. We focused on this already last week with the non-farm payrolls and the release of them, and already covered to some extent most of what I will repeat today. And then we want to have a look certainly at the inflation rate, why this matters, and also make sure that we all are on the same page when trading the most active currency pairs. Like EURUSD, dollar JPY, that especially inflation numbers next week, plus the ECB, plus the Fed the week then. After that, on the 20th of September, playing a very important role. And what's even more interesting is now you might say, well, I have to check out the economic calendar all the time. There's a great tool within the Supreme add-on from Admirals. You can download it for free on the website. I will just head over, by the way. Let me just head over here. Oh, I'm sorry. Let me just, I have to open a tab there. Go move it here. Then we go to admiralmarkets.com, and there you have the platforms, and there you see the MetaTrader Supreme add-on. So I share the link here within the chat box. So and download it for free, whether you're using MT5 or MT4, doesn't matter. And within this you will find this Supreme add-on then. And the economic calendar. And this is exactly what I will show you here within the chart in a few minutes. But first of all, we want to dig into today's topic and have a look here at the GDP growth rate, why it matters certainly, but also why it's not of such high importance, I would say, because it's kind of like, well, it depends to some extent. The most interesting thing, most likely, around the GDP is why there are releases 3 times a quarter. So you might have seen, let's probably move back here to the Forex calendar, analytics, Forex calendar, and then go to the last week of August. Let's take it from there. And then we want to filter all the big data news releases. Let's just look here at the Eurozone and the US. So high impact events, then we apply the filter, and let's just hope, by the way, let's just hope that the GDP is considered of high. Yeah, it is. Well, because the thing is, what I wanted to say is, sometimes you get the GDP under the, let's say, medium impact tab, which is no coincidence, because most of the time it just doesn't move the markets at all. And you can see here, this is probably the most interesting thing. You can see second estimate. So you get a first estimate. This is usually right the month after the quarter finishes. So for example, September, third quarter ends at the end of September, obviously, and then at the end of October, you will get a first print from the GDP data from the US, for example. Then the second month after that, which means end of November, you get a second estimate. Here, this is the second estimate for the second quarter, obviously, which ended in June. And then you get a final print at the end of the quarter. So at the end of December in this regard, probably this time it's around the beginning of next year, January. But however, you can now understand where these numbers come from, and usually they don't move that much. This is a negative surprise in this regard. So you can see the forecast was 2.4% because previously, not previously, but the first estimate was 2.4%. You usually don't expect it to be much different than from the first estimate. In this case, that was a negative surprise, in fact, because obviously they gave out a higher number than in fact the GDP was. However, this is the only really interesting thing. During my time in the markets, now for over 20 years, trading actively and also following the markets and news releases and the reaction of assets to these releases, macro events, especially in the FX market, I never really remember a time when GDP growth rates releases really triggered much volatility. And the reason for that is because it's like it's a very big indicator. So especially inflation numbers, respectively, retail sales, they impact the GDP growth rate. So usually you expect if people are disappointed about the political situation, for example, or are very skeptical, pessimistic about the overall economic outlook, especially over here in Germany, for example. I'm located in Berlin. So everyone is shaking their heads in disbelief. It's not just the countries outside of Germany shaking their heads in disbelief, especially when it comes to the policy in terms of energy, for example, but also here. So they are just, well, they're bringing in laws like where you just say, well, this doesn't make sense. Is it still democracy? It's like you really like you just shaking your head like what's going on here? For example, today, so like there's a law around, I don't even know how to translate this. It's like the Heizungsgesetz. It's about how you get your house warm, let's say. And long thing short, if you can afford to buy a house, and well, don't get me wrong, but I would never buy a house in Germany right now. I just there's no real motivation because I just don't know how this will affect the overall landscape. If you just bought a house and you think you did a good investment, I think that was the most catastrophic step you could ever make. If you didn't have this, I don't even know these. I don't even know if this is if there's an English word for this. If you made this and you went the, let's say, conservative path with classic fossil fuels heating your home, well, you'll most likely right now have a massive devaluation of your property, and like this snap of a finger, and they bring in this law. And so having this in mind, even though it might now seem kind of a rant against the government, well, it affects the overall economic situation because, well, you don't really see your future in this country anymore, and you're not very motivated to stay here, let's say, but you're more thinking about I'm going somewhere else where the weather is nicer and there's less tax and less bureaucracy, and I can have a nice life with my family, with my kids, and offer them something more, right? So having this in mind, this affects directly the overall economic growth. But all in all, if the numbers are released, usually this is kind of a like a Titanic, let's say. It really takes time since it moves, and since the market is a kind of a discounting mechanism, you usually have already seen the reaction to this, in this case, economic this disastrous economic development taking place with the high inflation rate, with lesser economic growth when looking, or also people not consuming as much, like retail sales coming down, and also in this environment, since we had raging inflation, the central bank hiking rates aggressively to counter this inflationary pressure. So all this, if we put all this together, well, you can already see, well, this is moving markets potentially, while the GDP growth rate, it's not moving much, it's that much, but still it's one of the most important economic indicators, certainly, because in the long run, especially if you're an investor, especially, well, you will certainly look at the overall economic outlook. And first of all, have a look here at the GDP growth rate. By the way, GDP, it's the gross domestic product, very important probably. And as you may have guessed already, you can easily Google that yourself. It's calculating the value of production for any country during a specific period of time, quarterly, yearly. And as you can see and might have guessed, usually each country looks for bigger growth and increasing its GDP over time. And a rising GDP then is considered a positive sign for the domestic currency. Why? Well, because more investors want to participate into this economic growth. So you will see capital inflows. You can look at a currency kind of like it's a stock for a big economy. That's how you will look at it. And if the stock has a positive outlook, or the company who issued the stocks is looking into a prosperous future and has a growth story behind it, and so on and so forth, you see investors buying the stock. The same is true if an economy grows, GDP growth rate rises, or a stable growth over a certain period of time, you usually see capital inflows into this currency, and usually you will see the currency rising against its counterparts. But what's more of interest here is certainly interest rate decisions. And as I already pointed out, and let's go back here to the economic calendar. Let's have a look at next week. And by the way, let's probably here go to Monday, and then let's have a look till next week here on Friday. And then you will see, well, there is some events next week, certainly. Inflation rate. This is what we will look at in 2 slides. But here's the ECB rate decision. And we have also the press conference, certainly. And we have the week after, this is the 20th of September, we have the Fed rate decision. And, well, why does this matter? Well, it matters because, as you can see, when it comes to interest rates, we speak about potential yield an investor or a buyer of a currency can expect to earn, respectively, has to pay if he wants to borrow money, for example, from a bank. And if a central bank decides to increase interest rates, or the rhetoric points into the direction that there's further rate hikes to be expected, for example, during times of significant economic growth, or right now in times of raging inflation, well, it should naturally result in higher demand on the local currency in order to get higher returns, and vice versa. One question you might have asked is, how does a central bank know what's the right interest rate? What's the fair yield level? And there is a theoretical approach to this. It's called the Taylor rule. And this is a screenshot I took years ago, just to illustrate here a theoretical fair value or fair yield level, which you can see in black, and then you can see in orange, in this case, the ECB, for example. The same is true also for the Fed. And well, that was before COVID and all that stuff. What we knew already was that due to the inhomogeneous situation in the overall European economy, higher yields never were an option. Well, Germany could have afforded higher yields due to the economic growth and the economic outlook. Right now, I would say, well, Germany can't afford higher yields too anymore. But coming back here to let's say 10 years ago, the thing is that we kept interest rates for too low for too long. And then there was this massive spike, or respectively push lower when COVID hit and there were lockdowns and all that stuff. And well, then we countered this by printing money and fiscal stimulus, which resulted in raging inflation. While there was more money, the simple term is there was more money chasing fewer goods due to the interruption of the supply chains, which is naturally driving prices higher. That's how this is economics 101. Everyone can learn this in the first semester. The problem is that most of, especially politicians sitting here at the ECB, well, probably have not gone through the first semester of economics, and if they have, well, probably they fell asleep or something like that, because, well, everyone was surprised. Well, not everyone. Someone just thinking about this for quite a while. It was clear once you do this, inflation will get out of control rather sooner than later. You could have seen that already over the course of the year in 2021, with inflation picking up already and accelerating. And then, well, the good news was, and to put this please in quotation marks, but there was this invasion in Ukraine, and then we could say, well, it was because it's Putin's fault, because he invaded there, and that's why we now see spikes in oil and everything. If you carefully watch, you could have seen that it was the last step higher in terms of the inflation. We have seen this already over the course of 2021, and there was no Ukraine war or invasion or something like that. It was because of politics, and inflation can only rise if the government behaves in a certain way, printing money, creating money out of thin air, and not making sure that the more in terms of money hits, let's say, more goods which are consumed then. And that's the simple reason for that. But we're already at inflation here. So this is just the theoretical idea behind this, how to get there. The Taylor rule, usually it should correlate with the interest rates of the respecting central bank. If it doesn't, as it did from 2015 onwards with this massive QE, the ECB launch, for example, well, then you're running into trouble rather sooner or later, and there will be lots of pain to bring back these two lines into sync, let's say. What's probably interesting right now around interest rate decisions, let me just head over here. I opened the MetaTrader already. So when looking at the Euro USD, you can certainly see that, especially here from the lows of 2022, around 95, we saw a massive bounce in the Euro USD up back to and slightly above 112. And that was an increase of something like 15% or so. The interesting thing is, and we are coming down now. Why is that? Well, I would say because right now it's not just a bounce in the US dollar, but also that the market is realizing more and more that the ECB can't really hike rates any further. The reason for that is because I would say the backbone, the economic backbone of the euro is the German economy, and the German economy right now is under enormous pressure. So really, the situation is worse than what you get in the media, and there's no optimism anymore. People are just like they just throw in the towel. If they had a business running, they just say, you know what, it doesn't make sense anymore. I can stay at home, get more money with no stress at all. And the government is paying me for that. So why should I work? Why should I take responsibility for people, hiring them and all that stuff? And this is exactly the current bias we have in Germany. So it's not just the central bank, but the central bank has to somehow counter this tendency, this economic downturn. And it has, especially when it comes to Germany, and it can do that by being more dovish in term or more expansive in terms of the monetary policy path they're following. So which means the market right now is, in my personal opinion, anticipating this, because there is a current tendency that the Fed is likely done, probably as one further 25 basis point rate hike, but then from mid-2024, we are potentially heading lower here and see the Fed cutting rates. And we are not expecting further rate hikes from the ECB anymore, which means the market is now discounting this, and that's why Euro USD is finding itself in this downtrend now for weeks and dropping back below the 200 SMA, for example. Why I mention all this? Let's have a look. Do I have it? No, I haven't it. One second, please. One second, please. I want to open GBP USD, and GBP USD. This is very interesting. Let me just here have a look. You can see the bounce was way more aggressive, and we haven't yet dropped to 200 SMA. And the thing is that I think that was around, I don't even remember her name, the prime minister before Sunak now, with some plans which just we're putting pound sterling massively under pressure and dropping towards the parity, and now we bounce to 130 and holding. I mean, we're getting to see some pull in right here, But we are still holding above the 200 SMA. And why do I mention this? Well, because I think that the BOE is not yet done in terms of its rate hike cycle, which means now the real yield differential between Great Britain, or respectively United Kingdom, and the US and the US dollar thus means that it will potentially shrink, which is positively affecting pound sterling, because it's now more attractive to buy pound sterling compared to the US dollar, which is longer term potentially a reason to consider GBP USD to be a long play, especially as long as we hold above the 200 SMA, I would say, and expecting a push back towards and probably above 130. I could really imagine that to play out due to the current inflation pressure we still have in the UK, and the likelihood of the Bank of England continue hiking rates, while the counterpart, in this case the Fed, will likelier cut rates. Thus, there will be a positive yield differential, positive for GBP, which means pound sterling is potentially bullish from there, if you consider it that way. I mean, you also have to take into account if you're continuously hiking rates, this is most likely negatively affecting the overall economy, and most likely also the consumption, like loan business and all that stuff. But all in all, this is something to take into account. Probably this is of interest for you if you're looking at the USD. Or respectively at the FX cycle, and we're wondering how things are developing, let's say in pound sterling, for example. Now, let's have a look at the unemployment situation. Unemployment rates, another very important indicator, even though not one we want to dig too deep into today, because we already digged very deep into it last week. So, as you know, unemployment rate is the number of unemployed people from the workforce in any country, and it's an important indicator which should be interpreted very carefully, as it's one of the main drivers of economic growth and thus price movement in the underlying currency. So usually you would say, well, numbers are good, strong, well, that's usually positively affecting the underlying currency, like NFPs are coming in stronger than expected. That's usually positively affecting USD, because the overall economy is most likely to grow, respectively to show strength to some extent, which makes it more likely that the underlying or the responsible, let's say, central bank will hike rates, respectively keep them higher for longer, and vice versa, certainly. And so as you may have guessed, a rising unemployment rate the other way around potentially means that the economy slows down, and vice versa. As I already pointed out, and one of the most important news releases, as you see, and as you may have guessed, because we are covering this each month at the first Friday each month, are the non-farm payrolls. And they give an information of the employment situation in the US, should be considered probably one of the most important news events. And just here, hop into our webinar series, and you will certainly see that. I have a screenshot from a long time ago, when EURUSD was still trading around 120, and here you could see it's somehow not that volatile anymore when these numbers are released, because the market participants are not that focused on the employment numbers anymore. Right now, it's more kind of like inflation, which is the current mode, let's say. And this is a very important aspect, especially when it comes to trading. You also and already and all the time have to be aware of the overall mode and what's of interest for market participants. And that being said, it means that you should keep an eye on what's currently moving the markets. Central bank decisions, rate decisions right now are definitely a play. There was a time when this was like, yeah, nice, there's the Fed chairman sitting there, or Fed chairwoman sitting there just talking, and the market wasn't moving at all, because everyone knew already that nothing has changed and won't change for a long time in terms of like QE and all that stuff. Well, then there's a time when this dramatically changes, and you have to be aware of that and spot these differences. And right now, even if numbers are sometimes creating some kind of volatility, let's say in gold or EURUSD, right now is not the right environment for big moves around the non-farm payrolls, even though we are still covering them, because you can draw conclusions out of that and spot nuances probably. What is currently definitely driving the market is certainly the inflation rate. And that's also something we want to have a look at in a few seconds, again, in the Forex calendar. So inflation rate is a term used in order to express the rate of change in prices of goods and services in a country. In the following, there's an overview on how inflation rates can be spotted in the economic calendar. You might be surprised. You can see CPI, Consumer Price Index. It's published on a monthly basis. It represents the rate of change in a basket of goods, services that are bought by consumers. It's massively manipulated. So the basket here is nothing compared to the 1980s, I think. If you take the basket from the 1980s, I mean, certainly the consumption changes over time, but most likely they changed this basket mainly due to the fact that if you take the basket out of the 1980s, most likely you will have inflation rates north of 20% or something. So that's probably very difficult very difficult aspect to communicate from a political standpoint. But then there's also certainly the core CPI, which makes sense because you have the same number as the CPI, but you exclude so-called volatile goods like food and energy, which doesn't make sense, to be honest, because this is necessary. To drive your car, you have to get fuel. You to be energetic, you have to eat something. Certainly, this is very, very important. But if you exclude them, and then you see that the core CPI continues to rise, while, for example, or it stabilizes, while the CPI itself, which includes these volatile goods, is dropping. This is most likely due to, for example, energy prices coming down. For example, due to an excess, short-term excess due to an invasion, war, Middle East, or like in the Ukraine right now or something. And the thing is, if you then realize that core CPI stays stable, we respectively see some upside, this is definitely a sign that to some extent the underlying central bank is most likely to continue hiking rates, respectively, keep them higher as longer as expected, probably. And this is most likely then affecting FX markets, but also gold, but also equity indices. And then there's another component, the so-called producer price index. It's it measures the rate of change in prices of inputs and outputs of goods at factory gates. So, which means like how much money do you have to spend to produce good XYZ and then sell it? You can't really forward it 100% to the consumer, the price increase to produce a good. But certainly, what you can say is there's a tendency that if the PPI rises, then usually rather sooner or later you will see also spike up in the CPI in this regard. And now let's have a look at next week and give an outlook already. We already pointed this out. So we have the PPI, which will be released next week on Thursday. This goes hand in hand with the ECB. But already on Wednesday, we have the CPI, which will be released. And what's really interesting, I would say, is to see, and this is interesting. Now we have an estimate here. And so in the morning, I'm still waiting for this estimate, 3.6%. You can see that the market is expecting inflation to pick up again. No big surprise. You follow these webinars very closely, I'm sure. And so you know that I was very skeptical if we can continue this massive decline over the last 12 months here, especially with WTI oil prices here having pushed to new yearly highs. And as you can see here, again, inflation came down, CPI came down because we came down in energy. Especially WTI after spiking up to 120 USD per barrel here in WTI, for example. So, and now we found a bottom. We pushed higher, and this is certainly a sign that the market, or respectively that inflation is not very likely to continue lower, but instead pushing higher, which means that the Fed could be forced to keep interest rates longer for higher than expected, which then, on the other hand, is something, let's look at the NASDAQ, for example, a reason to wonder, well, can we continue this bullishness we've seen, especially from May onwards, respectively following probably this mini banking crisis in the US over here in March? Or isn't it likely that we will probably see another leg lower, which will bring us, in case of the Nasdaq, down to, let's just here work a ABC, for example. We're probably pushing us as low as 14,000 points again, just roughly speaking. So this is certainly something to keep an eye on, and something to follow closely next week. Then once we get the release here of these numbers, and as you can see, this is the last bullet point. The interpretation of inflation depends mainly on the economic cycle and where we are. And right now we were in a declining inflationary environment. Now we probably have found a bottom and see a small bounce, but the bounce is probably enough to let the central bank, the Fed, then keep interest rates higher for longer than the market expected, which could then mean this is not fully priced in and result in some stronger moves, not just in equities and indices, as I pointed out, but also certainly in gold, very yield sensitive, inflation sensitive thus, and also, for example, FX pairs like Euro USD, dollar JPY, or GBP USD. And so I already showed this, where to find the Supreme add-on package for your EMT5. I already shared the link, by the way, and this is now the picture I have here. I haven't it open right now in the MetaTrader, so that's why I took the screenshot. But here you can highlight these news events in your economic calendar with no big problems, and I put this in quotation marks, because the Supreme add-on, once you downloaded it and you imported it into your MetaTrader, you can just search for it, and then you have all news events here highlighted in your platform. And by the way, it's also possible to select the most important news events, for example, which are then here with these red dots can be shown in the platform, and thus you're not missing any of these big news events anymore in the future. So you have them highlighted directly within your chart. And in fact, that's it for today. So your favorite stocks at a fraction of the price. I have mentioned this already at the beginning. Here in terms of the app, I highly recommend downloading. If you have any questions in regards to this, feel free to reach out to the Admirals directly via mail. Also, if you are watching this recording now on YouTube, please leave a thumb up here if you enjoyed what you witnessed. Please also subscribe to the channel. Click the reminder box. No, it's like the ringing bell, the bell, so that you get notifications once we are uploading trading content, which we produce here for the trading community, Paul, and also Theo, and myself included, certainly. And that's it from my end. So I wish you all the best. Happy trading. Watch your stops. Talk to you again next week on Friday. I really look forward to it. See you. Bye-bye.